Okay, in this training audio, we're going to talk a little bit about fundamental analysis of the Forex. Now, as we stand right now, Forex early warning, we are not fundamental analysts, we're technical analysts. There's two ways to analyze basically anything that's tradable, whether it's stocks, commodities, foreign exchange, whatever you're trading. There's fundamental analysis and there's technical analysis. For example, in the stock market, if a public company is not a profitable company, if they're a new company, but the CEO comes out and says that a company that is not profitable, and the CEO says the company is going to become profitable and that they're going to continue to increase profits for the next 3 years, that stock will start to rise and a trend will develop, and that stock could go up for a long time. So you can do fundamental analysis on stocks. Stock fundamentals are the earnings of the company and the company's management. Okay, in the spot Forex, you can incorporate fundamental analysis into the technical analysis if you wish. There's even a term for people like this. It's called a techno-fundamentalist. They analyze the fundamentals, then they wait till the trends develop, and then they get in on the side of the trade that they want to be on. That's not exactly what we do at Forex Early Warning. We're strictly more technical analysis. Now, technical analysis makes use of market trends. What we do is we do multiple time frame analysis. We take one set of indicators, red and green, and we apply it across multiple time frames. That's what we do. Fundamental analysis uses more broader things, economic data, things of that nature. At Forex Early Warning, we're technical traders, not from the standpoint of using a bunch of technical indicators. We use a very tiny amount of technical indicators, just trend indicators, and the same trend indicator across multiple time frames. So, but from a fundamental standpoint of the Forex, if you want to incorporate some of that into your trading, it's completely your choice. The biggest thing that influences currency prices is interest rates, the differential, and the direction. That's probably about 80 to 90% of what you need to know. Interest rate policy is the biggest driver of currency prices. Typically, that would fall into the category of fundamentals. So fundamentally, if a country is raising its interest rates, which is called strong monetary policy, the currency of that country will strengthen. The opposite is also true. If you believe that the Fed has finished raising rates for the time being, you could capitalize on that view by buying a currency with a higher interest rate, or at least the prospect of relatively higher rates. Now, there's other things that's the number one thing. There are other things that have some effect on rising currencies. For example, the price of gold and oil. If you see a big run up in the prices of gold, you're seeing inflation, geopolitical tension, things of that nature. But one thing you got to remember is Australia is the world's third largest exporter of gold. Canada is the world's third largest producer of gold. Obviously, countries, if you believe the price of gold is going to rise, you could establish a position in the Australian dollar or the Canadian dollar. Now, if the other big commodity is oil, equity investors already know these things. This is not something that, we're not operating in a vacuum here. The United States has massive foreign dependence on oil, okay? So some of the commodity-based economies like Australia and Japan, and then you have energy-dependent countries like, Australia and Canada, and then you have energy-dependent countries like Japan, U.S., things of that nature. So here's what I'm going to say is that the majority of the movement is related to the interest rates direction, monetary policy. As part of this audio, immediately below the audio, I'm going to give you a link. And the link is to a website at the Daily FX website. You click on it, and what this link is going to give you is it's going to give you the current interest rate and also the current forward policy, in other words, raising interest rates, lowering interest rates, or neutral for all the major currencies out there. So if you want to get into this, you can. Now, let me talk for a moment about the danger of what I call paralysis by analysis. You can take this information and you can take it way too far in about 5 minutes, and you're going to become a paralysis by analysis fundamental trader. Don't do this. Let me tell you why. If you look at the longest term trends that are in place, if you set up the free complimentary trading tools on my website, just look at the longest trends, the largest 2 or 3 trends. These trends are in place for a reason. So by being a trend trader, you are automatically a fundamental trader. This is because the Forex is the most efficient market and everything is built into the trend. The strategy that we use is we look at the biggest trends first, we analyze those, and then we either trade in the direction of the established trends or wait for a trend to establish. By doing that, we are fundamental traders, except that we don't have to look at the fundamentals. We just look at the largest trends and go with them, and you can see that the Forex early warning trader plans do just fine. So by being a trend trader and trading larger trend, the fundamentals are automatically built in. Let me give you another example of taking it too far, paralysis by analysis. All these economic announcements, CPI, CCI, GDP, NFP, GNP, I mean, if you want to sit there and analyze them all, that's certainly your business. We don't care. So just don't take this stuff too far. If you know the interest rate direction of a country, whether if it's rising, falling, or going sideways, that is 80 to 90% of what you need to know. And you can do it very quickly by looking at the information in the link I'm giving you. Now, that's the majority of what you need to know from a fundamental standpoint. All of these economic announcements, CPI, CCI, GDP, NFP, GNP, it's fine. But that's all absorbed into the market because the market is efficient. Everyone knows what these numbers are, and it translates into a trend. So, do you need to know about all the fundamental analysis? It's my opinion that you do not. But you need to know the trend, and you need to know what the larger trends are. So if you want to spend all of your time becoming an armchair economist, remember that economists are never wrong. If you look at the largest trend time frames, you won't be wrong either. The trends in the Forex exist for a reason. The Forex market is very efficient, and it is the most efficient market in the world. By efficient, it absorbs all the information and generates trends. That's why we trade it. If you do not see very large trends available in the market, currency pairs can start oscillating. That's fine for us. We will trade those. You will never see a trading plan issued by Forex Early Warning where it says, well, the fundamentals don't agree, we're not going to trade this way. Listen, currency pairs go against the fundamentals for strange reasons all the time. If we see a trend, we will trade it, and that's what we're going to do here. If you want to look a little further into it and maybe incorporate 5 to 10% of your knowledge base into fundamentals, please use this information on the link I'm providing you as a tool to do that. The majority of what you need to know is right in front of you in the trend indicators. However, if you need to know a little bit more, we're happy to provide that here at Forex Early Warning.